Hi, I will be talking about monetary policy located in Chapter 15 of Economics 203. So, first, let's talk about what monetary policy really is. Monetary policy refers to the actions taken by a central bank, such as the Federal Reserve in the US, to control and regulate the money supply and interest rates in an economy. The FED has two main objectives most of the time, often called a dual mandate when carrying out monetary policy. One is to ensure price stability, and two is to maintain full employment. But there are two different types of monetary policy. The first one is conventional monetary policy, and the second one is modern monetary policy. Conventional monetary policy consists of the reserve requirement, the discount rate, and the open market operations. The reserve requirement refers to the percentage of deposits that banks and other financial institutions are required to hold in reserve, either in cash or on deposit with the central bank. The discount rate refers to the interest rate at which the Federal Reserve or another central bank lends money to commercial banks and other depository institutions. The open market operations refers to the buying and selling of government securities by a central bank in the open market. Now let's talk about modern monetary policy. This consists of interest rate paid on reserves, FED loan facilities, and quantitative easing. Interest rate paid on reserves refers to the interest rate that a central bank pays to commercial banks on the reserves they hold with the central bank. FED loan facilities are basically established by the Federal Reserve to provide liquidity and support to financial institutions and markets during times of stress or crisis. And quantitative easing are used by central banks to stimulate the economy by purchasing government securities or other financial assets from the market. Lastly, let's talk about the federal funds rate. What is the federal funds rate? This is the interest rate at which the banks lend money to each other to meet the reserve requirements set by the Federal Reserve. And here I drew out two different graphs, one elastic and actually no, both inelastic. And in terms of what will shift the money supply curve back and forth, let's talk about how increases and decreases in monetary policy tools will shift the money supply curve. So actions that will increase the money supply curve are, let's talk about first, for conventional monetary policy tools, the decreasing the reserve requirement, decreasing the discount rate, and selling government bonds on the open market will all increase the money supply curve. For modern monetary policy tools, decreasing the interest rate paid on reserves, establishing additional FED loan facilities, and increasing quantitative easing will increase the money supply curve. Actions that will decrease the money supply will, for conventional monetary policy tools, consist of increasing the reserve requirement, increasing the discount rate, and decreasing the frequency of selling government bonds on the open market. Will all decrease the money supply. For modern monetary policy tools, increasing the interest rate paid on reserves, decreasing the frequency of establishing FED loan facilities, and decreasing quantitative easing will all decrease the money supply, shifting the curve to the left. Thank you.